a couple weeks away from tax deadline, so no, so, some of you might have some questions. Well, today I'm here with our friend. If you watch these live streams, you know he really knows his stuff about crypto taxes. Jordan Bays. He's a CPA. He also owns a crypto accounting firm and a crypto law firm. How's it going, Jordan?
It's going well. It's a busy time of the year, Daraj, as you know, and so it's getting down to the wire, at least on the initial deadline. But everyone, including tax professionals and taxpayers, are pushing through a little bit of, there's some complicated things that people are dealing with this year. So, understandably, it's taking a little longer to reconcile some of that activity and file their tax returns.
Yeah, yeah, absolutely. And I'm sure you're super busy. We also have our other guest, Miles Brooks. He's also a CPA. And as you guys know, if you're a regular listener, he has years of experience preparing tax returns for high net worth individuals. How's it going, Miles?
It's going great. Thanks for having us, Daraj.
Absolutely. So I think a great way to start things off would to be getting into the discussion of what people should do if they haven't gotten started with their tax returns yet, but they want to report their transactions. We'll start with Jordan.
It's a great question. It's something that we're seeing a ton of inquiries at the firm, and I know CoinLedger is seeing a ton with customer support tickets. You don't want to wait, obviously, until the last minute to file your taxes, specifically if you have some crypto activity, and it maybe complicates things. So what I always tell people, and what we've been doing actually for a long time now, it's been over a month, maybe 6 weeks or so, is people that are onboarding, we will, of course, try to pro forma and figure out in a projected manner what their tax liability might be, but we'll file an extension on the tax filing, because oftentimes during these last 2 or so weeks, when we're getting down to the wire, down to the deadline, and people are stressing about filing a timely return, they make mistakes, and then the mistakes follow with an amended return, and it's not like it's something that leads into an audit or something like that. It's just, why do it twice when you can get it done the first time properly? And so filing an extension is not the end of the world. You have the ability to file an extension, make an estimated payment, because it's not an extension to pay your taxes. It's merely an extension to file. So that's something I would advocate people to do, even if they've never done that in the past, because it is, in my opinion, very important to get it done right. And you don't want to be rushing against a deadline that, quite honestly, isn't so much a deadline for the filing purposes. It might be difficult to figure out how much you need to pay on April 18th. That is true. But it's better, in my opinion, to high level estimate that, maybe overpay and give the government a little bit of a loan. You'll get the money back if you file and you end up being overpaid. But you don't want to get into the position where you're stressing and you don't file anything at all, because the late filing penalty is much more severe than a late payment penalty. So that's something I would advocate for, and I think everyone should be aware that it's we get the question all the time: does that lead to further inquiries? Does that put me at a higher risk of audit? No. Tens of millions of U.S. taxpayers file extensions every year. So that would be my advice.
Yeah, that makes a lot of sense. Miles, any thoughts?
Yeah, I think I think if you have activity which warrants hiring a tax preparer, you're more likely to go on extension. And I think Jordan makes a great point that kind of this extension is available to anybody, whether or not they're working with a tax professional. And so if you do need that extra time, you want to pay into what you think you should owe, and then you can kind of true up and fix the return, do whatever you need to do, and file by October 15th. That being said, many people do have kind of all the tools at their disposal, especially through CoinLedger. The software is there and ready to use to file. For a lot of people, it's just kind of biting that bullet and saying, hey, I'm going to kind of carve out some time, and I'm going to spend some time on that this weekend, or kind of in an afternoon one day, to kind of open up that tax software program, open up CryptoTrader.tax, and just start plugging in the information. you may realize that it's really much easier than you think. And it's nothing to be scared of, especially with software that can kind of help you through the process. But it's also important to kind of get started as soon as you can, because you may realize, not everything's kind of as perfect as you would like. Kind of, you may maybe need to go back to my Coinbase account, etc. Whatever it is, you want to give yourself time to kind of perfect everything, get things right before that April 18th deadline. It's 18th this year rather than the typical 4/15 due to a holiday and a weekend. So you kind of have that extra weekend to push out your return should you be waiting until that very last moment.
Gotcha. Well said. So I do want to hop into some audience questions. I know we got a couple from Twitter. So let me look at this. The first one is question we hear quite often, and I think it's important to address. Do I pay a capital gain, or do I incur a capital gain when I pay ETH gas fees? Miles, you want to start this one off?
Yeah. This is a very nuanced topic. The fees and blockchain activity it's complicated. So unfortunately, there's kind of two sides to this. You're paying this fee, and this fee reduces your proceeds from a taxable event. And so when you have a taxable trade, you get the tax benefit of the fee, because if you trade $200 and there's a $10 fee there, you really only end up with 190. So your proceeds are 190. So you get the tax benefit of that fee. But the question was, if you pay your fee in ETH, is that a taxable event in and of itself? It really is. By using that fee and paying it in Ethereum still is crypto, considered a capital asset. And when you dispose of that ETH fee, that in and of itself is a taxable event, is a transaction that should be reported on your return.
Got it. That makes sense. Jordan, any thoughts on gas fees and how they're taxed?
No, Miles and I have actually had very in-depth conversations about this particular issue, and it is a little confusing. I do understand, because there's like multiple sides to the transaction, but quite honestly, I think Miles covered it, because at the end of the day, what you need to know is, on one side, right, there's like this disposition of ETH, but on the other side, it can reduce those proceeds. The net overall amount that you're receiving in the transaction is diminished, right? You're getting, like Miles said, you're purchasing something that's worth $200, but you're only getting $190 US dollar value in return. So there's not much to add there, other than the fact that fees aren't only used for purchasing something on, ETH, or purchasing an asset on a centralized exchange. So it can be more complicated and it can be more convoluted, which is what Miles mentioned. It's like kind of a loaded question, but for the purpose of that transaction and what most people are doing with those fees, I think Miles covered it perfectly.
Okay, awesome. So going through these questions from YouTube, somebody asked how ETH, just going from ETH to ETH2 would be taxed. Any thoughts there?
Yeah, we've also had a lot of discussions about this one internally, maybe not so much on the live stream, but you're locking that asset up when you're staking ETH. I'm assuming this is what this person is talking about. Maybe they're doing it on a centralized exchange, maybe not. And I'm of the opinion, the firm's of the opinion, that it's a non-taxable event. Miles may have other thoughts on the taxability of this, but in a sense, oftentimes what happens with this transaction, with this structure, is then those proceeds, or we can call them proceeds, they're locked up for a period of time, not being able to be reached. Effectively, you don't have control and custody of those assets. But the actual conversion from ETH to ETH2, there's not really much going on from a tax standpoint. In my opinion, you could argue that it is a taxable event, and that might be a very, very conservative approach to take. But at some point, we will have to convert all of these tokens to facilitate some of this network activity. So it's kind of like a token swap from one token to another that we saw in like 2017, 2018, where there was, one token, then a new native token, and we had to switch into that new native token in order to actually utilize the protocol or the app or the application that the project was either building, said they were building, or successfully built.
Right, right. I mean, my understanding was that if there's no newly created cryptocurrency, then there's no taxable event. So, I mean, at this point, like the ETH coins will be migrating to ETH2. So, it seems like a non-taxable event. Is that essentially correct?
At a high level, that's pretty much the structure and the flow of the transactions. But who knows? There might be delays in this process. We don't know if that ETH to ETH2 conversion, like when is that going to happen for the network? So I don't know how people want to approach that overall, all tax professionals, because some people differ in opinion on this particular position. But at the end of the day, I don't see that as new value being accrued or new value being created. It's merely a migration of token, to me.
Gotcha. Miles, any thoughts on going from ETH to ETH2 or ETH2 staking?
Yeah, I think when you're moving your ETH to ETH2, there's kind of these different pieces of what is a taxable event, and one of those pieces is there an exchange? And so I think that first piece is covered. The ETH is kind of structurally different than ETH2, and you're kind of getting a new asset there. The second part is, are they substantially identical? And that's kind of where the crux of this argument, I think, lies, is the ETH substantially identical to the ETH2? And I think you would find most people would say they are substantially identical. And in which case, that conversion from ETH to ETH2 would not be considered a taxable event. However, this is kind of a gray area, and we're waiting on IRS guidance from this. However, we can still use kind of legal doctrines that are already in place to kind of help form our opinion on this without necessarily having the IRS guidance. And so, if this conversion is extremely material to you, speak to a professional and because there can be a lot of nuance around a situation like this. And so
Yeah, just to make this clear, there's a lot of gray area when it comes to just cryptocurrency taxation in general, just because the IRS is so slow moving to some of these new protocols. So if you watch these live streams a lot, you'll see us saying that a lot. Looking through these other questions, it seems like a couple people have questions about just missing cost basis. Pretty common thing to run into, especially if you've done transfers between different exchanges and different wallets. So, Jordan, do you want to start things off by telling people what they should do if they run into issues where they can't figure out their cost basis or anything like that?
Sure. Oftentimes the missing basis issue comes down to two things. They're really the same thing, but it really comes down to two things. One, you might have had some previous data from a centralized exchange that's not included in your reconciliation, because all of these transactions build on top of each other. And so if you're missing basis in 2018 on a transaction that occurred, and it affects something in 2019, which then affects something in 2020, and so on and so forth, it can skew. It might not ultimately be the US dollar amount of the actual missing basis, but it can skew cost basis, and it could show, possibly when you're doing this internal reconciliation using a software like CryptoTrader.tax, that you're reaching into a tranche of tokens that doesn't exist, right? So you're overselling effectively, which means they might allocate no basis to that transaction. That's first, and that's really what we saw for many years until like 2020, when people started engaging in a lot of on-chain activity. The second missing basis high level thing that we see, and that most people probably on the stream are dealing with, is from something that occurred on chain. It could be a borrowing event where you collateralized an asset and borrowed against it, and it might be showing up as just an inflow, but you're not allocating basis to this deposit. It needs to show as loan proceeds, right? So you can get basis for that. Or there's some sort of swap that you did, there's some sort of liquidity that you provided within a protocol or moved it somewhere, and it's not aggregating properly. So you might need to supplement what a great software can do with some manual work, because there's only so much that data can read like, right? So those two things usually lead to some sort of missing basis activity, and it can be and it should be remedied because you most likely, if not undoubtedly, bought something of value with something that you had previously, used US dollars to acquire or US dollar value equivalent. So if that occurs and you have these missing transactions or something that shows up as, like a zero cost basis sale, you do want to really look in depth at that transaction, and softwares like CryptoTrader.tax will highlight exactly what the transaction is that's causing this issue. And then you can delve deeper into that transaction. Maybe you say, oh, I forgot to put this into the reconciliation report. Or maybe it's something that just needs a little bit of supplementation to the data aggregation that the software has provided for you. But those two things, missing data historically, or maybe nuanced transaction types that are difficult for softwares to actually allocate basis for, even though they scrape the information from the blockchain and it's there, needs some manual supplementation. And if that happens to you, you definitely want to remedy that, because 100% of the time, a missing basis issue will result in you overpaying or over whatever the gain is with that report. It's going to be higher than what it actually was in real life. So it's important to remedy for sure, but that does happen a lot.
Yeah, I mean, some of these transaction types are so nuanced, and there's just these new protocols popping up day after day. Sometimes, like, our team works very hard, but we can't even keep up. But our upcoming Ethereum wallet integration, which allows you to just copy and paste your Ethereum wallet address, and then pull in all your transactions, does have the option to classify your transactions just with the click of a button. So that's going to be awesome. Miles, anything you want to add on to what Jordan just said?
No, I think that pretty much covers it. I think it's important to, when you're remedying the situation, maybe do a quick analysis on, how material is this to the rest of your activity. If you're kind of spending hours and hours trying to kind of find missing cost basis on some coin that's like you would maybe find a couple $100 of basis on, well, when you pay the tax rate, you're like, let's say you're missing a couple $100. When you apply the tax rate, really it only comes down to, $100, $200, if that, of actual kind of materiality. So if this is a big chunk of all your income, definitely spend the time, figure this out. If it's potentially like just a small piece of it, maybe you bite the bullet, don't spend any hours on it, and you decided, hey, I'm just going to pick up like $0 of basis on those coins, and it's only going to affect me so much.
Got it. Yeah, I mean, it does make sense. Should be your approach may differ depending on your unique situation.
Yep.
So someone was asking in the chat, like, uh, I just don't have time to figure out all these numbers. Is there someone I can contact to prepare my crypto gains and losses? So again, a software like CoinLedger can definitely help you out, right? If you're having trouble and you have these trades from different exchanges and trades on the Ethereum blockchain, you could just pull up our software, figure out your cost basis and your total gains and losses through that. So, Jordan, I mean, you're a CPA, you do help people file their tax returns. When would you recommend someone come to an accountant?
That's a really great question, actually. And I wish people asked it more often, because I do think that a lot of, DIY is, I guess, the realm that CryptoTrader.tax lives in. The do-it-yourself tax reconciliation softwares are great, and they work well for most individuals. And even for some that have large portfolios or large amount of transactions, they probably should first start utilizing a software, right? Like CryptoTrader.tax, see if it's something that they can do, see if they want to spend some time, see if it's something that's even feasible based on their type of activity. Obviously, if their activity spans 13 different chains and they've bridged thousands of times, okay, maybe that will take hours and hours, tens of hours, possibly even 100 hours of work, and they don't have the time to do that. So sure, maybe that's you reach out to a tax professional immediately, or a firm that specializes in this, so that they can do it for you, or at least assist in the matter. But for most crypto investors and traders, a software solution is where they should first start, in my opinion. Utilize this subscription to the best of their ability. Don't, if they have an idea that it's going to be extremely complicated and they may need to reach out to a tax professional, maybe don't spend 50 hours using the software and then reach out to somebody. You don't want to make it feel like it's a waste of time, because oftentimes when that happens, the firm will have to start from scratch. They're not necessarily going to rely on the data that you've reconciled that isn't accurate and try to fix it from there. They might as well start from scratch. So I would say, once you've given it an effort on a software solution, and it's definitive that it will not work for you because it's either complicated or you just don't have the time to do it, then you should probably be reaching out to a tax professional. But these software solutions, and specifically what's about to come with CryptoTrader.tax/CoinLedger, when this Ethereum integration is open to the masses, it will solve a lot of problems for people, and it will minimize any legal or accounting fees that they would have otherwise not paid, but for dealing with crypto. So I think it's important to at least make an effort to do it internally yourself. But I mean, there's two types of reconciliations. One that we get where we know right away, oh, this is a complicated one, this is going to take a while. Or the other one where it's like, yes, this was probably more straightforward had the individual sat down and maybe took the time, like Miles mentioned, over the weekend or in an afternoon, and really focused. They probably could have done it themselves, right? So I think it differs for everyone. Everyone's different, but at the end of the day, most people should be trying to reconcile using a software that is being built like the one that CoinLedger is building. There's a lot of time, a lot of effort in doing this, so that people don't have to pay those extra fees for a CPA or a lawyer to get involved in those transaction processes. So yeah, that would take revenue away from my firms, but I don't care. I just want people to do the reporting correctly, so that they don't have to come to me as a lawyer and say, oh, I messed this up, can you help me? Or they don't have to come to us on the CPA side and have us do this reconciliation, when they could have definitely saved some money and done it themselves.
Right. And I mean, your team's so busy anyway. I'm sure the less clients.
And most people are. That's
true. Miles, anything you want to add to that?
No, I think that's great. Yeah, I think for most people, even people with complicated situations, by spending the time going through CryptoTrader.tax, you're going to be saving money on the back end, even if you have an accountant. So kind of by making everything tidy before sending it off to your accountant, you're going to save money on fees. And so kind of either way, I would say, go for CryptoTrader.tax first. If you can't get your answer because of the complexity, maybe time to seek out a professional.
Well said. So we did get a couple of follow-up questions on our ETH to ETH2 discussion, so I did want to address that just to make sure it was clear. Can we just go through the difference between like soft forks and hard forks and how they're taxed, just so people understand? Jordan, you want to kick this one off?
Sure. Well, we have guidance from the IRS on hard forks, right? And that was something that was released kind of late, which is something Daraj mentioned, right? We have new transaction structures that pop up, and the IRS, maybe Miles mentioned this, I don't remember, but the IRS is very late in providing guidance to some of these types of transactions because they're behind, right? Not only are they behind on crypto, they're behind on regular tax filings. There's some returns that have been filed 3-4 years ago that are still being processed, that at least that were paper filed, not electronically filed. Those get processed right away. But so we had this hard fork guidance, and when there's a hard fork coupled with a new asset that's created, effectively the Bitcoin Cash example, it was supposed to be treated as income upon receipt. There was an issue where some exchanges weren't honoring that hard fork, so someone didn't receive their Bitcoin Cash until later. IRS released further guidance that would stipulate that would be income upon them actually being able to exercise dominion and control over the Bitcoin Cash. That is it's like a hard fork coupled with an airdrop, and that is what the IRS provided guidance on in 2019. I think it was 2019. Now, that is not ETH to ETH2, right? It's just not. It's a very, very different transaction structure. And I think what Miles mentioned on the ETH to ETH2 conversion is actually the only thing that people necessarily need to be worried about when dealing with this tax issue. Is yes, he's correct. There is a transfer of assets. There is an exchange, right? ETH to ETH2. Is this, and I think someone provided a comment on the YouTube channel. How is that different? Someone said, does my Ethereum die after moving to ETH2? In a sense, kind of, right? But the argument would be on that particular transaction is that they are substantially identical, and if that's honored, not taxable, right? If it's not honored, which quite honestly, I can probably see an argument being made that they are different and that it is a taxable event. I can see it. I just am of the opinion that it's not, because to me it doesn't make economic sense, or else, why would I mean, yes, you might have to do that conversion to facilitate network activity in the future, but as of now, you don't necessarily need to. You don't need to, unless you want to earn some yield by locking up some of that ETH2, right? So the difference in this lies in the fact that, like you mentioned also, Daraj, there is a new asset being created, but it's not the same thing as this hard fork example that the IRS has provided guidance on, which is why if we were to get something definitive on this transaction structure, it would probably be by way of some sort of guidance, some sort of ruling from the IRS. But like Miles mentioned, and maybe he wants to go into this further as well, taking existing tax principles into consideration, the argument does come down to whether or not these assets are the same or not.
Yeah, Miles, the floor is yours.
Yeah, I don't really have much else to add. I think Jordan covered it. I think, the crux of what Jordan is saying is, professionals and taxpayers can kind of make all these arguments, but it's really going to be up to the IRS at first, and then furthermore the court system to kind of to reconcile some of these differences that may be playing out between how taxpayers think things should be handled and how the IRS thinks things should be handled. And so it can seem a certain way, but without official guidance and without these things being kind of worked through the courts, we can't know for certain. But I think there's kind of safety in either approach. If you're kind of making notes and writing down kind of your approach and why you think it's a certain way.
Got it. Well said. So we are at the 30-minute mark, so that's all the time we have. So thanks, Jordan, Miles, for your insights. Definitely much appreciated. So if you're interested in getting started with cryptotrader.tax/CoinLedger, you can click the link in the description. You can get started with the free preview report, start importing your accounts, and get comfortable with the platform and see if it really is right for you. If you're using the platform already and you have any questions for us or for filing your tax return, feel free to send a message to our support team, whether that's on the site itself or on help@cryptotrader.tax. We'll be happy to get that cleared up as soon as possible. Well, thanks all for tuning in, and we'll see you next month.
Awesome. Thank you.
Thanks, Daraj.
Bye now.